Welcome to Money and Markets Series 5, Lesson 3. We have seen how exchanges work, how orders enter a matching engine, find a counterparty, and create a transaction. This lesson is about one of the most successful financial products ever built on top of that infrastructure: the exchange-traded fund. ETFs hold assets, stocks, bonds, commodities, and trade on exchanges just like shares. Simple on the surface, but the mechanism that keeps their price honest is surprisingly elegant. And when that mechanism breaks down, things get interesting. In 1993, a small team at State Street Corporation launched an unusual product. It was a basket containing the 500 largest companies in the United States, bought in proportion to their size. You could own a piece of that basket, just like owning a single stock. The ticker was SPY. It was the first U.S. exchange-traded fund, and it would eventually become the most heavily traded financial instrument in the world. Today, trillions of dollars sit inside ETFs. They are in retirement accounts, pension funds, and savings plans around the world. But most people who own them have no idea how they actually work. This lesson fixes that. An exchange-traded fund is a fund that holds a collection of assets, whose shares trade on a stock exchange like individual stocks. Compare it to a mutual fund. Both hold collections of assets, but a mutual fund is priced once per day after the market closes. You buy or sell at that single end-of-day price. An ETF trades all day in real time like a stock. You can buy at 9:30 in the morning, sell at 2 in the afternoon, and capture the difference. That flexibility made ETFs enormously popular, but it creates an interesting engineering problem. How do you ensure that the price of an ETF share stays close to the value of the assets inside it when both are moving throughout the day? The answer is the creation and redemption mechanism. Every ETF has a true value. It is called the net asset value, or NAV. The NAV is calculated by taking the value of every asset inside the fund, stocks, bonds, whatever the fund holds, and dividing by the number of ETF shares outstanding. If an ETF holds $1 billion of assets and has 10 million shares outstanding, the NAV is $100 per share. In theory, the ETF should always trade at its NAV. If the market price rises above NAV, investors are paying more than the contents are worth. That is a premium. If it falls below, that is a discount. Small premiums and discounts exist briefly, almost constantly. But in liquid ETFs, they rarely exceed a fraction of a percent. The mechanism that keeps them close is called arbitrage. The key to how ETFs stay near their NAV is a special class of participant called an authorized participant, or AP. APs are large financial institutions, usually banks or major trading firms, who have a special agreement with the ETF issuer. Only they can create new ETF shares or redeem existing ones. They do this through in-kind transactions. No cash changes hands. Instead, baskets of the underlying securities are exchanged for ETF shares or vice versa. APs are not acting out of charity. They are acting out of arbitrage opportunity. And that profit motive is precisely what makes the whole system work. Here is how creation works. Say the ETF is trading at $102, but the NAV is $100. The ETF has a premium. An authorized participant notices this. It goes to the market and buys all the underlying stocks that make up the ETF, in the exact proportions the fund holds them. This basket costs $100. The AP then delivers this basket to the ETF issuer in exchange for new ETF shares, which it receives at NAV, $100 each. The AP now holds ETF shares it paid $100 for, and can sell them on the exchange for $102. That $2 profit is the reward. And the side effect: new shares were created, supply increased, and the premium closes. Redemption works in the opposite direction. Say the ETF is trading at $98, but NAV is 100. A discount. The AP buys ETF shares on the open market for $98. It returns those shares to the ETF issuer. In exchange, it receives the underlying basket of stocks worth $100 per share. Profit $2. And the side effect? ETF shares were removed from circulation, supply fell, and the discount closes. Creation and redemption together form a two-sided pressure valve. When the price rises above NAV, creation adds supply. When it falls below, redemption removes supply. Arbitrage makes this happen automatically, no central coordination needed. Does this always work perfectly? Almost, but not quite. In liquid ETFs like SPY, the premium or discount is typically less than 0.1%. APs are fast and active, and any gap closes almost instantly. But for ETFs that hold less liquid assets, like high-yield bonds or emerging market stocks, the underlying basket is harder to buy quickly. APs demand a bigger profit to take on the inventory risk. In March 2020, when COVID fears froze the corporate bond market, some bond ETFs briefly traded at discounts of 5 to 8%. The ETF was liquid. The bonds inside were not. That gap was not a malfunction. It was the ETF correctly reflecting the true price of a liquid assets that had not yet been forced to trade. ETFs carry risks that matter. Tracking error. An ETF may not perfectly replicate its index because of fees, taxes, and timing differences in rebalancing. Liquidity mismatch. As we just saw, an ETF can be more liquid than the assets it holds. In a crisis, that difference becomes visible. Synthetic ETFs. Some funds do not hold the actual assets. Instead, they use derivatives to replicate performance. This introduces counterparty risk. If the counterparty fails, the ETF fails. Index concentration. Many popular ETFs are heavily weighted toward a small number of giant companies. The S&P 500 ETF gives enormous weight to just 5 or 6 firms. Understanding what is inside your ETF is not optional. It is the job. An ETF holds a basket of assets whose shares trade on an exchange like a stock. The true value is the NAV, calculated from the underlying holdings. Authorized participants create new shares when the price rises above NAV, and redeem shares when the price falls below. Arbitrage keeps the price close automatically. The system works best when the underlying assets are liquid. When they are not, premiums and discounts can widen under stress. Compared to mutual funds, ETFs trade in real time, have lower fees, and are more tax efficient. But they still carry tracking error, liquidity mismatch risk, and concentration risk. In the next lesson, we leave the equity market entirely and enter the largest financial market in the world. Foreign exchange. $7 trillion changing hands every single day.